All right. This is our bank statement loan masterclass. This unpacking bank statement loan. So here's a big picture. What if your business earns more than your tax returns show? Right? Generating substantial revenue, have excellent credit, viable assets, maintain cash flow, significant reserves, make every payment on time, but their tax returns show limited income. Why? Well, because business owners legally deduct expenses. And the strategy that reduces taxable income can also reduce traditional mortgage qualifying income. So here's our agenda. We're going to understand the problem, review over bank statement loans, building the file, avoiding problems, and building that strategy, right? So these are kind of those points of what we want to discuss with you today and unpack a little bit. And at the end of this, I'll take some questions, but we'll stop recording there because I'm going to drop this on YouTube afterwards, if that's okay. All right. So start with the truth. Self-employed does that mean unqualified? They're not necessarily riskier. They're often simply more complicated to document. So a salaried employee may provide W-2s, pay stubs, employment verification. Business owner, multiple companies, K-1 income, retained earnings, depreciation, seasonal irregular income. See it all the time. Problem underwriter reviews taxable income, right? From these things, as I mentioned, tax returns, business returns, Schedule C, 120 or 1120s, right? If you got year-to-date profit and loss, you're looking at your 1065s, your K1s, right? Balance sheets. Lenders not simply looking at gross income, it's looking to calculate income available to borrow after business expenses obligations. $1 million business does not mean $1 million worth of income. Look at this. This is kind of an example here. Every legitimate income analysis must account for business expenses. Taxable income, cash flow. Not the same thing. They can be very different. Taxable income reduced by depreciation, vehicle expenses, home office deductions. Actual cash flow may show regular deposits, strong operating revenue, consistent owner distributions, significant liquidity, healthy business activity. So bank statement program evaluates deposits and applies expense analysis to estimate usable income. What's the bank statement loan? Alternative income documentation mortgage. Instead of relying solely on tax return income, the lender may review 12 months or 24 months of bank statements, personal statements, business statements, combination of accounts. There's no alternative way to document this. No, a way to avoid proving income. It's just an alternative way. Non-qualified mortgage, bad mortgage. Not true. It's not subprime. It's not 2005. Okay. Non-qualified mortgage loans may use alternative methods to document income using bank statement, P&L loans, asset utilization, 1099 income, investment cash flow. It doesn't mean no underwriting, no income analysis, no ability to repay, no credit review, no down payment. It doesn't mean, oh, you have a pulse, let's get you a loan. It's not that. Okay. It's not a no documentation loan. Again, not 2005. So this is what we're looking at. Here's a solution. Business verification, CPR tax preparer letter, profit and loss statement, expense analysis, credit report, asset documentation, verify it, appraisal ordered, title insurance review. Documentation's different, not absent. Potential bank statement borrowers, business owners, sole proprietors, independent contractors, consultants, real estate agents. A lot of my friends here, doctors and dentists. If you have my wife's friends, since she's a provider. But we see a lot of that. Restaurant owners, construction pros. I see a ton of contractors, online business owners. I see 1099 gig workers. I do. Rideshare, DoorDash. We see this stuff. The common issue is not an occupation, it's how the income appears on paper. Ownership matters. Borrower with significant business ownership is evaluated as self-employed. So proprietor, LLC, partnership, S Corp, C Corp, independent contractor. Bank statement program definitions vary. Review the ownership structure before selecting the income method. So personal bank statement programs. Here's some potential advantages. Owner draws distributions, commission income, 1089 receipts. So funds may already reflect net income after expenses. So the challenge, business and personal transfers must be understood. Not every deposit qualifies income automatically, right? So business bank statement programs analyze the deposits in the operating account of the business. Total eligible deposits, exclude the non-eligible, identify transfers, apply expense factor, calculate ownership share. Gross business deposits are not used as personal income without adjustment. 12 versus 24 months. What's better? So let's look at this. 12-month reflects recent performance for your statements more sensitive to volatility. 24, longer history. It smooths out the seasonality. It's benefited 24 months. It may reduce income if order deposits were lower at the same time. So we want to look at both, Kaylee, to see what's going to work best. So not every dollar counts. Business revenue, payroll deposits, transfers, loan proceeds, tax refunds, asset sales, right? On one time, just one time, big deposits out of nowhere. Cash deposits, right? So the goal is identifying recurring income generated by the business. Where did the money come from? Eligible customer payments, client fees, sales revenue, commission income, verified distributions. Excluded is transfers between owned accounts, loan proceeds, credit advances, tax refunds, sale of personal assets, or one-time windfall. So moving the same money between three accounts does not create three times the income. The expense factor calculator. Average deposit is 50,000, expense factor 50%, monthly business income 25K, ownership 100%. Well, there you go. $25,000 a month in income, right? Is what we show. Same deposits, very different income. 30% expense factor. That's what that looks like. 50% expense factor, 70% expense factor. So understanding the actual business model does matter here. So how is the expense factor determined? There's a standard fixed factor CPA prepared document or tax preparer letter, business questionnaire, profit and loss statement, industry-based assumptions. So a consulting business and a restaurant should not automatically be treated as if they have identical expenses. Let's remember that, right? Very different. CPA or tax preparer letters, we need to confirm ownership percentage, business existence, how long of time or tenure of self-employment, type of business, the operating expense. Confirm a CPA is not guaranteeing repayment. The letter must meet the program's exact requirements. Profit and loss statement. Another view of the business. Shows the gross revenue, cost of goods sold, your payroll, operating expenses, net income. Is it consistent with the deposit? So profit and loss may not be enough. Statements in the P&L should tell a consistent story, however, from bank statements to qualifying income. So let's look at this. 12 months, divide those on the average, come up with that expense ratio. This is a way to calculate as well, right? So it's just a worked example. Someone we had just kind of round the numbers about 2 months ago, I believe. This is when the deposits may reflect the owner income. So personal accounts can be simpler, much messier. It does depend on, of course, the business, right? So commingled funds, this is where it gets confusing. That's what you want to watch out for. Business and personal money in one account. What's deposits or business income? Which are personal? Are transfers being counted twice? Is the account truly personal or business? Can the source deposit be documented? Good bookkeeping is good mortgage preparation. Cash deposits require careful documentation. Are they consistent with the business? Can they be verified? Are amounts recurring? Deposits aligned with reported sales? Is there unexplained spikes? Cash-based businesses may qualify, but unexplained cash is not automatically acceptable income. So the most common deposit analysis problem, 25K in, $20,000 transfer, $15,000 transfer. All three are counted, $60,000, but actual business revenue in this exercise is 25K. So declining deposits, trends matter. So it may result in use of the lower period, required explanation, additional documentation, reduced qualifying income, loan and eligibility. So keep that in mind, right? So uneven income is not necessarily unstable income. Keep in mind, construction, tourism, tax preparation, holiday retail, landscaping, these things, right, can be seasonal and have seasonality to them. So the lender may analyze longer history to understand peak months, low months, and actual consistency. Slow month is not automatically a bad business, okay? Overdrafts. Insufficient funds charge don't help. Overdrafts don't hurt. Return payments, negative balances, volatility. Review the statements before submitting the loan, not after underwriting discovers the problem. It's good for every loan officer watching this, by the way. If you don't do that, do it. We do that, but want to make, if you're a home buyer or realtor watching this, keep that in mind. Those are things we look at. How long must the business exist? Well, like these things matter. Length of self-employment, time in the same industry, business license history. We look at these things. Secretary of State record, CPA confirmation. So shorter histories may be possible under select programs, but can require compensating factors. Alternative income does not mean alternative reality. The income method changes. Credit still risks still exist, right? There's down payment requirements, program eligibility. We're still underwriting this thing. Reserve requirements still exist. We still calculate with interest rates. Candidly, what we found recently is time to record this is bank statement loans and non-QM loans are actually pricing better than conventional loans in some cases. It's really interesting. But let's talk about this, about how much is required. 10% down, 15, 20, 25% down. Bank statement loans do not automatically mean 20, 30% down, but does typically require more equity than the lowest down payment agency program. So it's not a 5% down program, but we do have 10% down bank statement loan programs. Reserves and cash to close. So business owners need liquidity. So we do want to show strong cash to close coverage. Decent reserve, 6 to 12 months is preferred. Post-closing liquidity, we want to show that's healthy. Right? Those are closing with $17 left in the bank account. It's not a financial plan, right? Can business funds be used to close? Potentially, but the business must survive. So we need to verify that with the CPA. Just because the borrower owns a business does not mean every dollar is personal cash. Income is calculated differently. That still count. Total monthly obligations, qualifying monthly income. We're going to look at that. New housing payment, auto loans, credit cards, student loans. Remember, bank statement loans do not erase personal liabilities. What types of homes can be financed? Primary, secondary homes, investment properties, condos, multi-unit properties, unwarrantable condos, townhomes. Loan terms and requirements vary by occupancy. The best income method may change based on how the property will be used. Buying the home you'll live in. Calculate income using bank deposits. Select the appropriate expense factor. We want to confirm the reserves. Compare 12 and 24-month options. Evaluate down payment. Review credit. The loan should be structured before the offer is written. It's imperative really on any type of loan, really. We want to make sure all that's lined up and you're comfortable. Vacation home or business extension. Location, distance from primary home is what we're going to look at. Occupancy and proper use, rental activity, right? We're going to look at these things now. A property primarily operated as a rental property may not qualify as a second home. Occupancy must reflect the real intended use. Bank statement versus DSCR. I want to talk about this. If you buy an investment property, you use income of the property to qualify. If the cash flow is well on its own, this may be a good route to go in some cases. So it's more than just buying, right? Keep in mind that the reason for the transaction should determine the financing strategy. Cash out refinance, business investment, debt consolidation, home improvements, build liquidity, education, family needs. But also cash out increases debt, may increase the payment, uses that equity that you built up, creates transaction costs. Equity creates options. It doesn't, a property shouldn't be an ATM. I've always said it. You don't want a property that's an ATM with granite countertops. Right? Not a good look. So why are bank statement loans more expensive? Alternative documentation, non-agency underwriting, different risk, investor risk, greater program flexibility. Compare the cost of the loan with the value of achieving financial objective. Points to break even. So like anything, if you're going to pay points or buy down the interest rate, we want to look at it. Paying points makes sense when the benefit exceeds the upfront cost. 1 point is 1% of your loan amount. Look at the cost. How long does it take you to recover that? Doesn't make sense, right? Payment wise. What is opportunity cost? Use bank statement now, higher rate costs. Not necessarily higher rate, Kaylee, as I mentioned earlier, we're starting to see better rates with bank statement loans than we are in some conventional financing. But purchase a desired property, begin building equity, secure housing, potentially refinance later. Wait for traditional qualification. Potentially lower for your costs, and then you got to continue to rent, allow tax history to develop, risk changes, pricing rates, save additional funds. The cheaper loans not automatically the cheaper decision. Can you refinance later? Potentially, yes, you can. Yes. Tax return income supports qualifications where you can do a bank statement loan. But if you want to go into a conventional loan, yes, we need tax returns. Credit remains acceptable. Property has sufficient equity. It makes sense to refinance, right? So do not accept an unaffordable payment based on solely the hope of refinancing later. I'll make sure it fits your budget. So other self-employed income options, full documentation, traditional, 1 year tax return, 1099 only. There's a profit and loss only program as well. Asset utilization. So if your balance sheet is stronger than your income, DSCR loans, as I mentioned, chooses the investment property cash flow. We have presentations on that as well. 1089 programs, right? So 1 or 2 years of the 1089s, we use the year-to-date earnings. We have industry history, current contracts, right? 1089 gross income is generally not the same as usable net income. Remember that. So P&L loan programs. Benefits for your statements, current income analysis, useful for growing businesses. Challenges, documentation standards, higher pricing or lower leverage, program-specific restrictions. The details matter more than the program nickname. Asset utilization. This is a quick calculation on that. So eligible assets, let's say haircut reserves, remaining assets, 1.6. We want to divide that usually by 0.7, depending on what sort of asset it is, if it's stocks, bonds, securities, and then we could use that. So a borrower could be led on paper, balance sheet strong. So 10 biggest bank statement mistakes. 1, assuming every deposit counts. 2, counting transfers as income. 3, ignoring expense factors. 4, saying incomplete statements. 5, mixing personal and business money. 6, making unexplained large deposits. 7, ignoring declining revenue. 8, using all business cash for clothing. 9, choosing a loan program based only on rate. 10, waiting until after finding a home to calculate income. So the statement analysis should happen before the borrower shops. Should you prepare, 12 with 24-month bank statements, business license, Secretary of State filing, or CPA letter, year-to-date profit and loss, ownership documentation, right? And we guide through all this, but so requirements vary. Start with a complete initial review, usually an application. And here's a case study: a strong cash flow, taxable income. Establish a consulting business. I had a client do this. 12-month business deposits were pulled. We used the expense factor. We confirmed the ownership structure. That was it. Borrower did not suddenly earn more money, but we used documentation method that better reflect the business cash flow. So 80,000 was not 80,000 of income, right? So we have the business operating account, savings account, personal checking, right? So after removing transfers, it was actually, substantially lower. So lesson is cash movement is not cash generation. Recent income was stronger. So 24-month analysis here. Older, lower deposits reduced the income average. So we used 12 months. It looked better. Business was growing. The documentation period can materially change the outcome. So here's a playbook. Separate personal and business accounts. Avoid unnecessary transfers. Document large source of deposits. Keep complete monthly statements. Maintain adequate reserves. Avoid repeated non-sufficient funds. Keep business records current. Understand your ownership structure. Review your credit early. Calculate income before shopping. Compare traditional and alternative programs, and structure the mortgage around that long-term plan, right? So here are 7 questions, 1 strategy. This is what we want to do. What type of business do you own? How long have you been self-employed? Are deposits primarily personal or business? Average monthly deposits, estimated business expense ratio or percentage. How much cash do you want to use? What property type? That's where you start, right? And then really to schedule a call to go over all of that, there's a QR code. Scan it. My contact information is there. And in the caption, I'm here to help. I really do want to help. So any questions on any of these things, let me know. Love to get a call with you. Go over how to make this work.